It's great to be here. I can see everybody had coffee, so we're going to have an interactive session. Thank you. That's awesome. I was already introduced, so I'll skip through that. The picture you see in the background here is one of our executive dinners through Products That Count. Every once in a while, we gather, a handful of product executives and entrepreneurs, and we talk about what does it take to build an amazing product. And if you're interested in attending one of those dinners, I encourage you to go to our website, productsthatcount.com/leaders, and fill out a quick application. So I'm going to start with a few mythbusters about fundraising. I see a lot of entrepreneurs come to me and tell me, in essence, I'm the next Mark Zuckerberg, I'm going to start the next Facebook, and therefore, I don't really need a degree. I'm just going to have to build my product, and then everybody will want to use it. And then really, I don't care about investors. All I want is their money. And I'm here to tell you that, no, that's not how it works. So first thing, when you look at numbers, 15% of the Forbes 400 CEOs don't have a college degree. Then you're thinking, well, maybe I don't need one either. And a lot of the students that I speak to are telling me, like, I'm thinking of dropping out, and so on and so forth. But that's actually not looking at apples to apples, because really, 50% of every entrepreneur in the United States has a college degree. So if you compare successful entrepreneurs with a college degree to successful entrepreneurs without a college degree, then you're actually 6 times more likely to succeed when you have a college degree than when you don't. So for the students in this room, just keep studying hard. Next myth, right? Build it and they will come. Marketing, sales, all that, that's like from the old economy. All I need to do is build something that's going to go viral, and then everybody's going to want it. Not so. And here is a slide from with screenshots from a couple months ago. On the left side, you'll see the decacorns, the unicorns valued at $10 billion and more. And it's a little bit hard to see, but are there some observations you can make here? What do you notice when you look at this? Yes, China. Half of those decacorns are coming from China. My eyes are on China for the future of innovation, right? Second, what else do you notice? How do these companies make money? They charge their customers directly. Hey, how about that for a concept? Somebody finds something valuable, and therefore they're going to be willing to pay for it. Yes, that's how most of the businesses are making their money, as opposed to building something that's for free and then getting somebody else, like an advertiser, to pay for it. And then if you look on the right side, you'll see the recent stock line of some companies that are public and that are making money that way. Not looking so great, right? So revenue and paying customers is your best bet to build a successful business. So get back to the basics of business. And then, anybody knows someone on this slide? Warren Buffett, yes. Who would you rather take money from? And there is always one person in this room, who will say, the other guy. I will not fund you. So why would you want money from Warren Buffett as opposed to the other one? He values value. That's awesome. Yes. Why else? How else can you benefit from having Warren Buffett as an investor? Network, media. Yeah. He's a very successful investor, so when he makes an investment, people look up to him and say, that must be a great company, right? Versus the other person, who knows? Or maybe we know, but we won't tell. So this is how Warren Buffett does due diligence. He doesn't just like grab a coffee with you at Coupa Cafe in Palo Alto and write you a check. He does a bunch of due diligence. He like looks at your company over time. your traction, how it progresses, your team, how you're able to build it and grow it as a successful executive team. He looks at the market, the opportunity. He does a very thorough due diligence, and then he invests. And that's how, partly, he's been so successful. So the message here is investors do a lot of work, but it's better to have them involved, because if they're not involved, if they just like give you a check and then you can run with it, something like that can happen. Do you know what that is? Enron, yes, agency costs. So get smart money when you're an entrepreneur. It's going to get you way farther than just getting the green money. Now, first lesson for this talk is the Facebook model is not replicable, so it's better to try and get a business degree if you want to be a successful business owner. Going back to the business basics as opposed to build it and they will come, and getting smart money as opposed to just getting dollars. Now, a lot of entrepreneurs say, I'm going to look at the next Facebook, and I recommend, like, don't do that. Try to build a business with the basics of, thank you, with the basics of business. You'll be more successful, and as an investor, that's the kind of deals that I'm looking at. So with that, then the question is like, okay, how do you communicate how great of a company you are to an investor? And as entrepreneurs, as a former entrepreneur myself, I'm used to selling to customers, right? So I have a product, and I sell it to a potential customer for value, right? As a CEO, as an entrepreneur, the product you're selling to an investor is your company, and your buyer is your investor. So what I'm going to do is I'm going to draw a parallel between the two and highlight how they are similar but different. And I'm going to use the 4 Ps. Can I see a show of hands? Who's familiar with the 4 Ps? Okay, most people, right? The 4 Ps of building great products, except I'm going to add a 5th one, which is people, in the case of a company. It should be first, but I'll talk about it last. So the first P, product, when you describe your company as a product, I recommend you use what I call a business equation, and we'll get into more detail about it. The price is your valuation, and we'll talk a lot about what that means and the difference between a valuation and the total cost of ownership of your company. How you promote your product to investors is primarily through warm introductions as opposed to some other investor marketing tactics. And then placements is you want professional investors. So let's dive into the first one, product. And we're going to go from the basics. What's that? A balance sheet. Yes. And what's on the left side of a balance sheet? Assets. And on the right side? Liability and equity. You're like, SC, we already know that. That's awesome. Not everybody knows this, I guarantee you, when I talk to different audiences. On the left side of the balance sheet, that's where your revenue goes, right? The cash, the account receivable. And then on the right side of your balance sheet, that's where your equity goes. So your customer and your investor go into 2 different sides of your balance sheet. And the more revenue you get, cash, account receivable, the bigger your equity gets. So for an investor to show them how their investment is going to appreciate, you're going to need to show them how you're going to grow revenue, because the total of assets and liability plus equity is the same. So revenue is a very simple business equation in economics 101. It's volume times price. Volume is number of transactions. Price is revenue per transaction. And depending on the type of business you're building, velocity will play an important role in the nature of number of transactions. It will be either one customer has many transactions, right? High velocity business like e-commerce, you want one customer to buy very often. Or low velocity business, number of customer is kind of the same as number of transactions per customer. If you buy a car, for example, you're not going to buy like 10 cars in a month, right? You're going to buy 1 car every few years. So your business equation looks like this, right? Revenue is number of customers, that's your acquisition strategy, times number of transactions per customer, that's your engagement strategy, times revenue per customer, that's your monetization strategy. And my recommendation for you when you're trying to pitch an investor is to go from that business equation and say, here's my acquisition strategy, here's how I'm going to get more customers, here's my engagement strategy, here's how I'm going to get them to buy more often from me, and then here's my monetization strategy, here's how I'm going to get money from the value that I provide. Now the second P is price. Okay, so this is a picture that my husband took. He races motorcycles. Not just motorcycles, he races Ducatis, right? The Ferraris of motorcycles. And so after a race, he stopped by like a nice place and, you know, relaxed for a little while and took this picture of the Ducati by the fire. Now, to him, how much do you think he pays for an experience like that? It's priceless. It's priceless, and especially I'm not in the picture, so it's really even more priceless. Now, he had to pay at some point for the Ducati, right? So when you go and you look at, you know, in a Ducati dealership, you look at the price tag, you have, you know, the list price, and then when you get out of the store with your Ducati, you pay a lot more. Right? You guys understand that? I see some heads nodding like, yeah, I've seen that before, of course. Because you bought maintenance, you bought upgrades, you bought services, taxes, and so on. So your total cost of ownership of that Ducati is a lot higher than the list price. Well, guess what? For your company, it's exactly the same. And I see a lot of entrepreneurs tell me like, oh, I want a high valuation because that's really what matters, and so on and so forth. Not so. What matters is your total cost of ownership. How much are you giving away when you're selling pieces of your equity, and it's not just your valuation. So the thing to pay attention to is the total cost of ownership, right? Terms and valuation, all of that matters, not just the list price, not just the valuation. Third P, promotions. So there's lots of ways to do marketing, right? When you market your product, you think about online marketing, you think about direct marketing, calling people, you think about channel marketing. And when you market to your investors, my recommendation is really only warm introductions, i.e. referrals. And more specifically, referrals from two types of people. People who invest and have invested in you, or people who don't invest but have an expertise that's relevant to your business. I get entrepreneurs all the time come to me and say, hey, you know, sorry you're not going to invest, but can you recommend me to other investors? So let's play this scenario for a second. Hey, Bob, I think this company is awesome. I'm not going to invest, but really you should. What is that going to do for you? So only ask investors if they have invested in you. Otherwise, ask like advisors, non-investors to introduce you to other investors. The kind of introductions you want, a warm intro, I have an example here of what a warm intro looks like when it's a real endorsement. It's like, I've invested in this company, I believe in it, I'm leading the next round, I think you should get in on a great deal. That's the kind of introductions you want. What you don't want, on the other hand, is online marketing. The AngelList, I think they're an awesome service if you're extremely, extremely early, but after that, blind introductions this way is not a very effective way to reach investors. You don't want to do cold calling. It's almost a waste of your time to do cold calling of investors. And then unless you're very, very late stage, you don't want to do channel marketing, i.e. go through an investment bank to raise money. This is not common practice at all in Silicon Valley. In other parts of the world, it's a lot more common. But if you're going to raise money from Silicon Valley, I don't recommend you go through an investment bank. Now, one of the huge differences between being an investor and being an operator, an entrepreneur, is that as an entrepreneur, your job is to say yes. Yes, we'll deliver this. Yes, Mr. Customer will fix this. Yes, we'll be on time. yes, we'll do a discount, and so on and so forth. Your job as an investor is to always say no. So 99% of the time. So when an entrepreneur comes to you and says, you know, we're really struggling with our product and sales and marketing are not taking off, and my co-founder and I, we keep arguing, I think we really need just a little bit of money to get over all that. Most likely you're going to hear a no. Like, who wants to get in on a deal that's struggling so much, right? Instead, the story that's going to get an investor to say yes when their default answer is always no is, oh my God, we have so many orders, we have such an amazing product, everybody wants to join the team, all we need is a little bit of money to grow faster than we're already growing. Then, oh, as an investor, I'm thinking, well, that train is already leaving the station, and I might get on it and get a good deal out of it. Let me consider it, right? Now, I say the job of an investor is to say no, but not all investors are equal. And that's a common misconception I hear from entrepreneurs. They're thinking, like, it doesn't matter where I get this money, like all investors are just the same. And I think there are three segments of investors: whales, dolphins, and minnows. Now, who has heard of that segmentation before in a completely different context? Yes, I see a few hands. This segmentation comes from the gaming and social and consumer industry. So in gaming, a whale is somebody who buys all your gear, like the shiny armor, the purple swords, and all that good stuff, right? So they actually make you all the money you need to continue building your game. Well, an investor who's a whale is exactly the same. They're going to give you a ton of money, and in exchange, just like in gaming, you're going to have to do everything they want if you want to keep them happy, right? So before you take money from a whale, like a very large investor, you want to make sure that you're prepared to lose control, you're prepared to no longer be your own boss, and you're also prepared to go for like a very, very big exit, because they're not going to let you, make money for yourself and then start the next company. They want to go for the whole end-to-end, IPO big game. If they offer you $10 million and you don't know how you're going to spend $10 million, my recommendation is don't take it. Wait a little bit. Maybe you'll take it later when you know how you're going to spend that. Then there are dolphins, and I'd like to think that Mighty Capital is a dolphin. The dolphin is, in the world of gaming, the person who comes to you and tells you, hey, you should really play Candy Crush. It's awesome, right? So they're the social butterflies. Your success is their success, like swimming with the dolphins. And in the world of investing, it's exactly the same. There are some investors who, if you're successful, you're going to make them successful. And so they're going to do everything they can to support you and make sure that you're going to be successful. So those dolphins, my recommendation is that you want to have quite a few on your cap table. You want to seek them out. And the way you evaluate them is by looking at how well they play in your ecosystem. Do they have special access that's going to allow you to swim faster, basically? And then you have minnows. And the minnows represent about 99% of a gamer's audience. They're here for the show, and it's cool, and it's fun, but they're not really very active participants in your game. Well, it's the very same thing with investor. The minnows, they love being entertained, they love being on your cap table, they're rooting for you, but they cannot do very much for you. So you're going to need some of them, but be mindful that they may take a lot of your time for a limited value. Okay, so the last P is the people team, the people one, your management team. So that's probably the most important part when you're pitching your company. And a few things that I learned here, I learned because when I started my last company, I was looking for a co-founder. And I started going to people and say, hey, do you want to be my co-founder? And everybody would say, no, I'm not interested. And it made me feel really desperate. And so instead, I started going to them and say, hey, I know you're looking for a co-founder. I can hook you up with a bunch of co-founders, including me. And then I got to all of a sudden be the most popular person in the room because everybody wanted to start a company. And I also, by the way, got first pick at finding my co-founder. And I also got to interview thousands of potential co-founders. Few things that I learned from that is that when you look for a co-founder or a management team by extension, you're really looking for three things. One is a complementary skill set. You want to make sure that it's not all engineers, not all business people. You want to make sure that you have diversity of skills. Two is you want to have a compatible communication style because you know there's going to be obstacles and difficulties along the road. You want to come out of those difficulties with something constructive, right? So you want to be able to talk to one another. And then three is you want to have a comparable, identical risk profile. And why is that? Well, so let's say you have a company and a potential acquirer comes to you and says, I'm going to buy your company for $15 million. And you went just like, excuse me, like this is insulting. And some of you may think like, well, $15 million, I could buy 5 Ferraris or 5 Ducatis and I could start another company and self-fund it and so on and so forth. That's pretty awesome. I'm going to take that. Now, if you two are co-founders, you're not going to be on the same page when it comes to your exit, right? So the reason I say you want to have the same risk profile is because you want to understand that you want to go all the way to IPO together, or you want to do a quick exit together. You have to be aligned on what it is that you're looking for the end game. And I think that's it, and we have a few minutes for questions. Walk over here if you have questions.
You mentioned about investment banking. Can you throw some light on how do you choose one, or what are the pros and cons with working with them?
Yeah, so when I mentioned investment banking, I said if you're raising money in Silicon Valley, unless you're at a very late stage, don't use an investment bank. If you're outside of Silicon Valley, it's a different game. Now, when you look at an investment bank, let's say you're in Silicon Valley, so you're at a relatively late stage, and you're basically saying, I want to find an investment bank that's going to help me sell my company, or that's going to help me go IPO. And so the type of bank that you want to select are banks that know who could buy your company, know those buyers, those potential buyers, and is going to be able to help you package this, your company and sell it to those potential buyers. So look for people who have connections at potential buyers. Look for people, of course, who have a reputation. And then if you're looking to raise money outside of Silicon Valley and you want to hire an investment bank, most likely what will happen is you will need to raise, let's say you want to raise like $500,000, right? So you're early stage and you want to grow. An investment bank is going to think, okay, so what's my commission on $500,000? It's very tiny. So actually, I think you should raise $2 million because then my commission is going to be a lot bigger. And whether you need that $2 million or not, whether that's easy or not to raise, well, that's a consideration. But my commission is also a consideration, right? So watch out for that kind of behaviors.
Hi, great talk. Thanks for your talk. Had a question on the warm intro part. So I run a company in Canada, and sometimes, like not just me, but for example, some other Canadian startups also face a problem in getting warm intros in the Valley, just because you don't have that network. So what would be your kind of your 2 cents on the best way in such situations?
Yeah, that's a question I get a lot. Thank you for asking it. So the question is, if you're not connected to Silicon Valley, if you're an outsider, how do you get money from Silicon Valley? So I mentioned 2 ways, right? Like one is an investor who has invested in you, and you may have some of those where you're from in Canada. So ask them for introductions to Silicon Valley insiders. And then the second way is advisors who are not investors, do not invest, but are going to see that there's an opportunity in their field of expertise and ask them to become a formal advisor. And then after they've helped you a little bit, then ask them for introduction to investors. So that's sort of 2 ways to get inside. Like investor insider, like through another investor, or through an advisor that's already local?
Thanks for the great words of wisdom. I think I learned a lot. So I guess my question is, it's kind of specific to me, but I'm sure some people in the audience share my experience. So the question is, like I'm an entrepreneur, I have some customers, I'm in the hot area of artificial intelligence. Like one of the challenges I struggle into is like the time I have to invest to convince an investor is like too high. So I was wondering, what is a scalable way wherein I can like reach out? What is a scalable way to raise funds? Because I want to focus my time on building product and getting customers versus raising funds, convincing some investor to give me 50K. It's just a struggle, right?
Yeah.
Would love to get your insights on what is that scalable way of doing it in a very efficient, timely manner. And the other insight would be if I'm engaging with an investor who wants to invest in my company, this time investment how to make, right? And are there any early indicators wherein I can get convinced that, hey, they're probably more in terms of sucking, or getting them educated versus like actually really funding companies? Would love to get your insights or experience on how to weed out and how to better scale up and use time efficiently for an entrepreneur.
Yeah. So the question is, how do I raise money without spending too much time on it? And then once I have investors, how do I not waste too much time educating them? So I'll start with the second one, if you don't mind. And I'll tell you, like, if you have investors that you need to educate extensively on your business, they're probably not the right investors. Remember that segmentation, the minnows, like you may have too many of those and they're using up a lot of your time. So one way to be more efficient is to have maybe an investor newsletter, right? Every month or every quarter, you send an update on the business. You say, this is where we're doing great. This is where we're pushing. This is where we're struggling. That very often takes care of like pretty much every like one of those one-on-one meetings. Maybe you do also like a joint call with all your investors or something like that. But you sort of think about it as this is a process to manage, and how do you manage it most efficiently with various methods of communication that are going to answer their questions. Now, to your first question, there's kind of two sides to it. One is you need to spend time raising money because it's your most critical job, right? If you don't have money, that's like the number one reason a business will, fail is it runs out of money. So it's actually, up to you as the CEO of the company to make time for that, because that's your most critical job. Now that said, maybe things sometimes get out of control and you spend too much time pitching your business. Well, then, you need to look back and say, do I have the right pitch? And maybe you think about, improving the way you pitch to investors. The reason I make a parallel like this between like pitching your product to a customer and pitching your company to an investor is because most entrepreneurs, when they come and pitch to me, they pitch to me as if I'm a customer. So they say, look, I have a great product and it does this and it has that and it, and I don't care because I'm an investor. And if you're trying to sell me your product and I'm not your customer, I'm saying, well, do you know that I'm not your target? Like, are you thinking about your business the right way? So it kind of works against you, right? So first is look at your pitch. Maybe your pitch needs improvement. And second, maybe also look at who you're pitching. Because if you're pitching to people who aren't active investors, then maybe they sort of drag you on, and that can happen. I don't think it's it's definitely not a good thing, but that can happen. So sort of try to evaluate or understand or qualify your investors by asking them, like, how many deals have they done recently? Or how actively are they looking to raise money? Is this an area they want to invest in? Is this a stage they're interested in? Is this the right geography? Try to qualify them to understand if you have a shot at getting their money or not.
Hi, great presentation. I have one question about the management team. You mentioned about compatible communication style. So I just want to know more about that, and also what are the sort of guardrail you built around the founding team to avoid any future, let's say, some dispute among founders?
Yeah, so the question is about team, like how do you know if you can communicate well? Well, first of all, communication, as the CEO of the company, it's your job to learn how to communicate with everyone. So there's no kind of magic formula or we're compatible, we're not. And it's your job to build the culture of the company, your job to hire a diverse team so you actually have like diverse viewpoint and you can communicate and grow effectively. So you really need to own that. It's a very important part. There's lots of ways you can do that, building culture, bringing in coaches, doing like assessment like the Enneagram and Strengths Finders and things like that. And I do recommend that you spend a lot of time on that because it's really, really important. The other part of your question was about how do you sort of set boundaries with the founding team, the management, and so on. So a lot of that is sort of, way more than just like 2 minutes. But a lot of that is tied to like, maybe putting in a vesting schedule for, the equity that the different co-founders have in the mix, making sure that everybody is in the right place in terms of like the role they have with the organization, and constantly like assessing, building, growing, grooming your team and your culture. Like that job never ends, and it's probably one of the, after fundraising, it's the most important skill of a CEO. All right, I think we're out of time. Thank you.